Welcome from Hudgins Research. We believe successful asset allocation requires a forward-looking perspective. It means recognizing pivotal moments in the market cycle. Now, while recent years favored certain asset classes, the landscape we think is shifting. Today, we will examine data that reveals a compelling two-part story for private real estate. An attractive entry point combined with a history of strong post-downturn performance. Okay, first, let's look at some stats on the relative performance. That really has implications for both relative valuation and relative performance moving forward. Beginning in mid-2022, private real estate underwent a significant reset as property values declined. The result? Private real estate significantly underperformed relative to private corporate debt over that period. Now, that relative performance gap has created what we see as a historically attractive entry point for real estate investing. If performance were to revert to its historical relationship between the two asset classes, closing this gap would imply significant upside potential. However, the opportunity becomes even clearer when we look at historical precedents. This chart shows what happened after similar resets for private real estate. Looking across three comparable downturns since 2000, we found that in only one cycle, the one around the Great Recession in 2008 and 2009, did real estate experience both declines greater than 20%, but also underperform corporate debt investments by over 40%. And in the 5 years following that cycle, private real estate outperformed private corporate debt by nearly 20%. As we note in the chart here, the valuation reset we have seen since mid-2022, as well as the underperformance relative to corporate debt, is most similar in scale to that of the 2008-2010 downturn. So we think this historical context provides a powerful guide for what may come next. Early signals already do suggest that the real estate recovery is underway, with private real estate indices posting consecutive quarters of positive returns. Maybe we can call it a positive reset. In the end, the playbook for this cycle is about proactive positioning. We believe the combination of an attractive entry valuation today and a historical pattern of strong recoveries creates a compelling window for investors. By reallocating capital toward high-quality private real estate, investors could position their portfolios to participate in the early stages of a recovery cycle and capture the potential long-term value creation taking shape across real assets.